Here's what they're not telling you about silver. Last video I said if silver held $72 support, we'd see potential for a base formation and technical recovery. That was tape reading education, not prediction. Well, silver's currently trading around $82 per ounce as I'm recording this on February 13th, 2026. But here's the development mainstream won't touch. Shanghai Futures Exchange just dropped Notice 2026-37 on February 5th. 6 groups of linked accounts caught exceeding intraday position limits on silver contracts. SHFE imposed restricted position opening measures on all of them. That is not normal enforcement. That's intervention during coordinated short attacks. Silver Market Insider here, and if you're learning real market structure instead of CNBC propaganda, comment Silver Truth below so I know you're paying attention. Now here's the new development the mainstream won't cover. While Western paper markets were getting hammered with coordinated selling, Shanghai was restricting the accounts doing the hammering. Current prices as I'm recording this on February 13th, 2026, COMEX silver spot, $82.90 per ounce. March 2026 silver futures trading around 74 and 72 per ounce based on delayed quotes. Gold for context, $5,001 per ounce. Now here's where it gets interesting. Shanghai silver on February 11th, most recent data before Chinese New Year, approximately $32 per ounce equivalent when converted from yuan, showing a plus 4% premium over COMEX pricing at $31 at that time. But understand what that premium represents. That's physical demand in the East refusing to back down despite Western paper manipulation campaigns. When Shanghai commands premium pricing while COMEX consolidates, that tells you which market reflects actual physical metal and which one's running leveraged paper games. Typical Shanghai premiums historically run 2 to 3% during normal market conditions. We're now seeing 4% and expanding. Check Shanghai Gold Exchange official data yourself. Shanghai Futures Exchange publishes this publicly. The yuan-denominated contracts on SHFE trade at approximately 7,116 yuan per kilogram. Convert that through the exchange rate, add the structural premium, and you see Eastern buyers paying more for the same metal. They're not doing that because they enjoy overpaying. They're doing it because physical delivery certainty matters more than paper price discovery when system stress builds. The premium expansion signals one thing. Eastern markets don't trust Western exchanges to deliver when push comes to shove. Let's talk about what's happening inside COMEX right now. As of February 11, 2026, COMEX total warehouse stock stands at 381.5 million ounces. But here's what matters. Registered silver, metal actually available for delivery, sits at approximately 102 million ounces. That's down from 135 million ounces just weeks ago in early January. 33 million ounces yanked in less than 4 weeks. That's 26% of registered inventory vanishing in days. Now look at March 2026 open interest. Multiple sources report between 85,000 and 91,000 contracts still open. Let's use the conservative number, 85,000 contracts. Each contract represents 5,000 ounces, 5,000 x 5,000 burger, 425 million ounces of paper claims. 425 million ounces claimed versus 102 million ounces registered. That's a coverage ratio of 4.17 to 1. 4 paper claims for every physical ounce available. Now understand what that means. If even 25% of those contracts stand for delivery, that's 106 million ounces demanded against 102 million registered. COMEX doesn't have the metal. But they'll just roll the contracts forward. Some will. Many already have. But here's what the rollover data isn't showing you. The contracts that are standing for delivery represent conviction buyers. These aren't speculators getting shaken out. These are entities demanding physical metal during a structural shortage. That is not normal market behavior. That is intervention-level stress. When registered inventory bleeds 26% in 1 month while open interest stays elevated approaching first notice day, February 27th, you're watching delivery pressure mount in real time. Check CME Group's official delivery reports. Publicly accessible, updated daily. The silverstocks.xls file on their delivery reports page shows you exactly what's disappearing. Is COMEX fighting for its life to stay solvent? Watch what happens when March contract holders decide whether to roll or demand metal. Now let's talk about March 2026 delivery pressure. Open interest for March silver futures, 85,000 to 91,000 contracts still standing as of early February. Let's use 85,000 for conservative analysis. 85,000 contracts x 5,000 ounces per contract, 425 million ounces of theoretical delivery obligation against 102 million ounces of registered inventory. That's a 4.17 to 1 paper to physical ratio. But here's what mainstream won't tell you about what's already happening. February 2026, a historically minor delivery month, saw delivery demands of 18.72 million ounces from total open interest of 19.11 million ounces. That's a 98% delivery rate in a minor month. January 2026 delivered 49.4 million ounces, 4.17 times January 2025 levels, and 7.27 times January 2024. These are not normal futures market patterns where contracts roll forward. This is physical allocation behavior. And here's the truly wild part. Traders rolled contracts backward. Multiple sources reported 355 contracts rolled from March back into January, February to demand immediate delivery instead of waiting. You read that right. Traders paid premiums to get metal now rather than wait for March. That represents 1.775 million ounces of demand that couldn't wait 3 weeks. When market participants sacrifice time value to secure physical immediately, you're watching panic buying disguised as futures activity. First notice day for March, February 27, 2026, 14 days away as I'm recording. Historical delivery percentages for major months run 15-20%. Conservative estimate 20% of 425 million takers, 85 million ounces demanded. Registered inventory right now, 102 million, but inventory is bleeding 785,000 ounces per day based on recent drain rates. 14 days x 785,000 merch, 11 million additional ounces potentially withdrawn before first notice day. That leaves 91 million ounces available versus 85 million minimum demand if only 20% stand for delivery. Margin of error, 6 million ounces. If delivery rate hits 25%, just 5 points above historical average, COMEX needs 106 million ounces against 91 million available. They don't have it. Check CME delivery reports yourself, publicly accessible. Updated daily. The withdrawal acceleration tells you entities are securing metal before March chaos hits. Last video I said if $71 support held after the violent liquidation, we'd see potential for V-shaped recovery with base formation around $80. That was technical structure education, not prediction. Here's what actually happened. Silver bottomed at $71.04 on February 3rd, exactly where major Fibonacci support clustered. Since then, price recovered to current levels around $82, $83, establishing structural support at $81, $50. But we haven't seen violent displacement with volume confirmation yet. What we're seeing is consolidation, price grinding between $78 and $86 resistance. That's not weakness. That's base building before the next leg. Critical resistance overhead, $84 on the 4-hour chart. Clean break above that level with conviction and volume targets 92 or 30. The recent high before the shakeout. Support underneath $78, which aligns with the 50-period exponential moving average on 4-hour time frame. As long as price holds above $78, the bullish structure remains intact. You don't catch falling knives, you wait for confluences to build. Right now we're watching for price reclaiming $84 with volume follow through above $86 local resistance base formation completion with higher lows. Here's what's coming that matters. FOMC meeting minutes release, February 18, 2026, 5 days away. Core PCE price index, Fed's preferred inflation gauge, February 20th. Flash manufacturing PMI data, February 20th. These releases determine short-term volatility. If inflation data runs hot, metals catch bids as Fed pivot narrative strengthens. If data comes soft, dollar weakens, commodities rally. Either way, volatility creates the displacement we're waiting for. That's not indecisive, that's disciplined. Let the market prove structure before committing capital to directional plays. Here's what the shakeout actually accomplished. SLV holdings as of February 12, 2026, 16,974.18 tons, approximately 520 million ounces. That's down from 16,236.18 tons just days earlier, a loss of 62 tons or roughly 2 million ounces. Now let's put that in context. Silver crashed from 121.64 on January 29th to 71.04 on February 3rd, a 41% collapse in 5 days. Yet SLV only bled 2 million ounces during the entire washout period. Over 1 month, net flows show approximately negative $82 million in dollar outflows. That's roughly 2.4 million ounces when calculated at average prices during the period. Think about that. Silver fell 41%, but holders only dumped 2 to 2.5 million ounces from the largest silver ETF. For context, SLV holds 520 million total ounces. That's 0.4% sold during a historic crash labeled a 22 sigma event, the worst single-day decline since 1980. That tells you retail holders aren't panic selling. Funny how silver can fall 41% without anyone actually selling. The lack of volume speaks volumes. When price moves violently but ETF outflows stay minimal, you're watching something else drive the collapse. CME hiked margin requirements twice in 4 days during late January. Initial margin jumped to 15% on silver futures. That forced leverage speculators, many on Chinese exchanges using 10x, 20x leverage, into liquidation cascades. This wasn't fundamental selling. This was algorithmic spoofing combined with coordinated margin squeeze. Multiple everything sell-offs hit markets simultaneously. Equities, crypto, $1.7 billion in crypto liquidations alone, and metals. When everything sells at once with razor-thin volume, that's not fundamental repricing. That's liquidity extraction and coordinated suppression. Check SLV shares outstanding data yourself, reported daily by BlackRock, publicly accessible through custodian disclosures. 16,174 tons on February 12th. The number doesn't lie. Physical holders didn't capitulate despite 41% crash. Now let me connect the geopolitical chess game mainstream is ignoring. Central banks bought 863.3 tons of gold in 2025, down 21% year over year, but still 82% above the 2010-2021 average of 473 tons. That's the fourth largest expansion of central bank gold reserves on record. Poland led the way with 102 tons added in 2025, bringing total holdings to 550 tons, 28% of their official reserves. Turkey bought gold for 23 consecutive months through October. China officially reported adding 27 tons in 2025, but that's heavily understated given their unreported accumulation patterns. Here's what the numbers really mean. Between October 2024 and October 2025, BRICS nations dumped $183.2 billion in U.S. treasuries. China, $71.4 billion sold. Brazil, $61.1 billion sold. India, $50.7 billion sold, their first decline in 4 years. Just in October 2025 alone, BRICS cut $28.8 billion. Meanwhile, they're adding 250 plus tons of gold annually to reserves. When the largest foreign holders systematically reduce dollar exposure while accumulating physical metal, that's not temporary repositioning, that's structural shift. The dollar's share of global foreign exchange reserves dropped from 71% in 1999 to 58% by early 2026. Foreign ownership of U.S. Treasuries fell from 50% in 2014 to roughly 33% today. Gold surpassed U.S. Treasuries to become the world's top reserve asset in late 2025 for the first time in modern history. Central banks are moving from treasuries to gold for real safety. BRICS now represents 47.9% of global population and nearly 40% of global GDP by purchasing power parity. They control approximately 50% of global gold production through member states and strategic partners. Combined BRICS gold reserves, over 6,000 tons. Russia, 336 tons. China, 2,298 tons, officially likely much higher. India, 880 tons. Here's the mechanism that matters. BRICS launched the unit payment system, 40% backed by gold, 60% backed by BRICS currencies, as direct alternative to SWIFT. BRICS Pay already reduced USD usage and intra-block trade by 2/3. This isn't theoretical anymore. This is operational infrastructure bypassing dollar settlement entirely. The rally in gold began when Fed cut rates despite 3% plus GDP growth, creating perfect conditions for non-yielding assets. Silver followed with 150% gains in 2025, breaking $100 for first time ever. No major crisis has hit yet. But when the next liquidity event strikes, whether banking stress, debt ceiling crisis, or geopolitical flashpoint, metals become the only assets without counterparty risk. Bearish case matters because you need both sides. Technical risks using actual current levels. Silver at $82.90 hasn't cleanly reclaimed $84 resistance yet. Could drop back towards $78 support if that level breaks, potentially testing $72 again where the recent bottom formed. Timing risks matter right now. Shanghai markets close February 10th, 17 for Chinese New Year. That creates a manipulation window where Western paper markets operate without Eastern physical buying pressure as counterbalance. Banks still have tools to suppress paper price through concentrated shorts during low liquidity holiday periods. Historical precedent can't be ignored. COMEX has contained these situations repeatedly throughout decades. JP Morgan paid $920 million in September 2020. Case 1 at 19 CR 00438, United States District Court, District of Connecticut. Admitted guilt to 8 years of spoofing and manipulation from 2008 through 2016. Hundreds of thousands of fraudulent orders in precious metals and treasury markets. CFTC imposed largest fine in its history. Department of Justice filed wire fraud charges. Yet the same trading desks returned to operation after settlement. The same individuals who caused $300 million in market participant losses continued trading. Paper manipulation persisted before it can persist again. Mechanical escape valves exist for exchanges. Contracts can roll forward to avoid delivery. Recent data shows 355 contracts rolled backward from March to January, February, 1.775 million ounces demanding immediate delivery rather than waiting. But historically, most contracts do roll forward during delivery pressure. Cash settlement can be enforced under exchange rules during force majeure events. February 2026 saw a 98% delivery rate according to some analysis, 18.72 million ounces from 19.11 million open interest. But that's February, a historically minor month. Major banks have survived delivery squeezes before by simply refusing physical settlement and paying cash premiums instead. This is financial warfare education, not investment advice. Capital preservation comes first. The ones who survive volatility are positioned when the real move comes. But here's the counter. Shanghai premium $4 per ounce and expanding, not contracting. Physical in the East commanding 4% premiums while Western paper consolidates. COMEX 102 million registered versus 425 million March claims. 4.17 to 1 paper to physical ratio. Registered inventory down 33 million ounces in 4 weeks, 26% bleed in 1 month. February delivered 18.72 million ounces from 19.11 million open interest, 98% delivery rate in a minor month. January delivered 49.4 million ounces, 7.27 times January 2024 levels. 5 contracts rolled backward to demand immediate delivery, 1.775 million ounces that couldn't wait. Banks extracted only 2 million ounces from SLV during the entire 41% crash. Silver bounced exactly from 71.04 as Fibonacci support indicated. SHFE suspended 6 groups of linked accounts in 1 week via Notice 2026-37. Central banks bought 863 tons gold in 2025 while dumping $183.2 billion in U.S. Treasuries. When manipulation requires margin hikes, thin volume, everything sell-offs, and coordinated attacks just to extract 2 million ounces and force 98% delivery rates instead of contract rollovers, that's not strength, that's desperation masked by volatility. Here's what matters now. Silver 82.90, $84 resistance overhead, clean break with volume targets 92.30, $78 support underneath, holds bullish structure intact. Shanghai premium $4 expanding, not contracting despite holiday closure. COMEX 102 million registered, bleeding 785,000 ounces daily. March OI 425 million ounces versus 4.17x coverage ratio. Watch March delivery intentions leading to first notice day February 27th, 14 days away. Watch Shanghai premium when markets reopen February 17th. Watch FOMC minutes February 18th and core PCE data February 20. Watch if $78 support holds or breaks. Watch if $84 resistance gets reclaimed with conviction and volume. This isn't about prediction. This is about observation. Let the market prove itself through price action, volume confirmation, and delivery data, not hype or headlines. The ones who do that homework see manipulation failing to achieve objectives. They understand why $4 premium matters when it keeps expanding during supposed bear raids. They recognize the pattern when support holds exactly where technical analysis indicated, while fundamental pressure builds underneath paper suppression. Invest with logic, not hype. Silver Market Insider out and about.